The MMB proudly announces the carbon neutrality of all its conferences, and as all of them, this is also a carbon-free event. With reforestation towards a greener financial system, 50,000 trees herald the central bank's green transition, and this number will increase in every year. The Hungarian Central Bank was among the first in Europe to receive an environmental sustainability mandate as one of its core tasks. Magyar Nemzeti Bank promotes the green transition of the financial system through incentive programs, recommendations, analyses and discussion papers. The Hungarian Central Bank intends to set an example for Hungarian financial institutions by reducing and neutralizing its own carbon footprint. In line with this objective, the MMB offsets its carbon emissions caused by its own operation by financing habitat restoration projects every year. The MMB implemented a smaller pilot project in Pápoteszér as a start. Then, in 2022, it financed a reforestation project the size of almost 40 football fields in Gest in order to offset the impact of emissions from its own operations. The central bank is committed to maintaining this practice in the future.
Dear all, welcome back. We continue with the closing session of the conference. It is only fitting that the closing session should cover a topic that points towards the future: systemic underpricing of climate risks in financial markets. Does it warrant a macroprudential response? The session will start with a keynote presentation of Mr. Matias Ossandon Busch, Director of Financial Stability at the Center for Latin American Monetary Studies. Afterwards, we will hear two further presentations. First, we will hear Ms. Paola Dorazio, Junior Professor of Economics at Chemnitz University of Technology, and then Mr. András Borsos, economist at the Magyar Nemzeti Bank and researcher at the Complexity Science Hub, Vienna. Ms. Dorazio and Mr. Borsos, please take a seat on the stage. And now I pass the words to Mr. Ossandon Busch.
So, thank you for staying until this very important session. I'm very happy to be here. Thank you for the organizers to host us. It has been a very interesting conference with lots of important discussions that I'm sure are going to influence our work in our different central banks and institutions in the coming months. I am pleased to have the opportunity to present the introductory remarks for this session, and I wanted to use this opportunity to present preliminary results from novel research we have been conducting at CEMLA. This is the title we're working on: Stranded in the Wastelands, Natural Capital Depletion and Bank Deposit Reallocation. This is joint work with Manuel, who is here, and two more colleagues also from CEMLA. But I'm going to divide this short presentation in two parts, and before I turn to the details of this particular applied research example, I'm going to touch upon something that remain maybe missing, partially missing, although Serafin was referring to this in the previous session, which is the aspect of nature risk or natural risk. So we were discussing already the implications of climate change, but I want to discuss this with you very briefly, why it is important to distinguish between risks that may arise from climate change per se versus those that may arise from the degradation of the environment or the loss of natural capital. Obviously, two things that are closely interconnected, but that also have important differences between them. And I'm going to highlight them very briefly. So what you see here is a summary of probably some stylized facts that we all are aware of at this point in time. When we think about climate or nature-related risk, we often think about this already well-established distinction between physical risk and transition risks. We know that the materialization of this risk affect the economy, for example, through the destruction of assets, the loss of value of financial assets, but also through the reallocation of productive factors, both people and capital and firms. In terms of connecting these consequences of climate risk with the financial system, we know that when there are losses in the prices of assets, for example, houses and firms, then you will have losses that will be absorbed by the financial system. You will have potentially higher non-performing loan shares in the banking sector, and certainly operational risks of all sorts. And this is kind of the usual argument we're used to hear when we try to connect conceptually the idea of climate and nature-related risks with financial risk per se. Now, there is a distinction that I wanted to invite you to think about, which is a distinction between climate risk and nature risks. Obviously, two things, as I mentioned at the beginning, that are close interrelated, but forcing a little bit, I think it's a useful exercise to try to think about the similarities, but also the differences between these two sources of risk. On the left-hand side, you see a few ideas that I think are shared by these two sources of risk. For example, that we are often thinking about long-term horizons, not in the sense of the materialization of risk, which is short-term, but in the sense of, for example, how to forecast the materialization of those risks using models that need to predict factors that will materialize over long horizons. The nonlinearity of these effects, tipping points, the presence of physical and transition risks, and certainly the double materiality, which is the word that environmental researchers use to refer to what we as economists know as double causality, right? So the idea that environmental shocks can affect the financial sector, but the financial sector can also cause environmental disruptions by its own activity. Now, nature risk, and I want to understand here nature in the most broad possible way, so in the sense of considering both biotic and abiotic elements in our planet that contribute to biodiversity. So this can be on the one hand side elements like, for example, the animals that you have, bacteria that you have in a certain ecosystem, but also water and other natural resources that are important for those living beings to be sustained, right? So keeping that definition in mind, nature risks are different in a few important dimensions, at least in my view. One is that we often think about localized impacts. Obviously, there are exceptions to this. If we are talking about the destruction of the Amazonia rainforest in Brazil, this has a global impact, that's true. But think about the following example. When you are owning a firm and this firm is polluting and is emitting greenhouse gases, you probably will have effects that are not only focused in your city, they can have effects on a global scale. It depends on the winds, it depends on how this pollution is going to be transmitted. If I am cutting trees and destroying a park in Budapest, this is going to have a direct effect in the city. So this is a very localized effect. We can pin down easily where this destruction is taking place and where the consequences can be observed, which is much more difficult in the case of climate risk because it's a universal phenomenon, right? Second, the timing of the tipping points is different because it can happen at different points in time, even within a country, right? Depending on how disrupted natural environments are. And very important for what I'm going to talk in the next couple of minutes, there are two dimensions I wanted to highlight. One is the lack of data, the lack of the capacity to define the loss of natural capital. There are obviously many attempts to do this, but this is very challenging. Second, the scale of the policy response. So most of you know, for example, the Paris Agreement, right? 2015, we more or less can associate certain targets with the Paris Agreement, but probably not many of you know about the Aichi Agreement, which was signed in 2010, so 5 years before the Paris Agreement. This was an agreement signed during the UN Convention on Biological Diversity. It's completely forgotten in time. It was supposed to promote the achievement of targets in the protection of natural capital until 2020. No one knows about this, right? And this is symptomatic about the distinction between climate-related risk and natural risk. Natural risks have remained below the radar for quite a long time, as Serafin was correctly pointing out before. So these are distinctions that I wanted to highlight. Now, in terms of connecting nature risks with the financial sector, with risks that materialize in the financial sector, probably the main idea that we need to keep in mind is that we are always thinking about the degradation of ecosystems. So think about ecosystem as something that has a certain quality, an environment that has a certain quality that we can measure from 1 to 100, right? And then suddenly we see that this environment is becoming degraded. So it's less able to produce to provide the natural goods that it was historically provided. And obviously things like overexploitation, climate change itself, or pollution are factors that drive this effect. maybe one of the main distinctions between climate risk and nature risk comes when we think about the materialization of physical risks. When we think about physical risk in the area of climate change, we normally think about natural disasters, for example, right? Hurricanes and things like this, floods. Well, in terms of nature risk, when we use the word physical risk, we typically think about destruction of ecosystem services. So it's a slightly different thing. It's not about the materialization of a natural disaster, it's about the destruction of certain goods that are provided to all of us by the nature, and that are obviously the supply of those public goods is proportional to the quality of the ecosystem. If we have a weaker ecosystem, then we will have a weaker supply of those goods. And this is maybe a key distinction. Transition risks are very similar. And then we have micro and macro effects going from stranded assets to effects on supply chains, productivity, and certainly on prices. At the end, this materializes in the financial sector with the usual consequences we have been talking about: credit risk, market risk, operational risk. Now, this is important to be kept in mind because when we are trying to identify the effect of losses in natural capital, we will need to be able to think about how we could measure the consequences of losing ecosystem services. And this is super difficult, as you can imagine. There is a strong discussion about this, for example, just to give you one idea that this is something concrete and not like magic. If you look at the news, maybe some of you have been following this, there is a very high discussion in California nowadays regarding the production of almond milk. Maybe some of you, I don't know how popular almond milk is in Hungary, but in the US it's very popular. And California is a very important producer of almond milk. To produce almond milk, you need, guess, almonds. And to pollinize the almond trees, you need bees. And they have been facing a huge decrease in the presence of bees of different sorts in California, at the point that there are even criminal activities around stealing bees from farmers that are producing them. And this is happening as we speak in California. You can see reports of this in the news, in TV. So this is something practical, and I can think about other examples in other jurisdictions, certainly. Before I give you an example of how you can measure this thing, I wanted to make a short break for 30 seconds and make some advertisement. So at CEMLA, we have been working on these issues. And since most of you are in the central banking community, I thought that it was good to highlight some of these aspects so that maybe we can find some shared opportunities for joint work in the future. We created 1.5 years ago, the Climate Financial Risk Center, which is a joint cooperation between CEMLA, we are hosting the Secretariat, and the United Nations Environmental Program. It has financial support from the European Commission through the Euroclima program, and it also has other partners, as for example ASBA, which is the Association of the Banking Supervisors in the Americas. So far, the center has been working on 3 main work streams that are highlighted here. First, a work stream focused on macro modeling. We have been working together hand in hand with central banks, trying to tweak the core macro models of them to include climate-related risk in macro modeling at central banks. Second, we are working, particularly this year, we will be working on a similar exercise on stress testing, so the topic that Serafino was just discussing. Similar thing, we are working on use cases, applied use cases with 8 central banks that are going to be developing their own stress testing together with us, and this information is going to be obviously published. And finally, training. We have been developing, for example, initiatives like Climate Academy with the Florence School of Banking and Finance, and a course on sustainable taxonomies, to mention just a few examples. What is very important for us, and this is an important message for you, is that we are putting a lot of effort in trying to disseminate this information. For example, through the Latin American Journal of Central Banking, which is an open access journal. You can go to the website of this journal and you will find there the applications that will facilitate replicating the studies and the methodologies that have been being developed in the context of the center. That said, I wanted to bring now your attention to the Jaguarundi, or Jaguarundi. I don't know which is the right, Jaguarundi probably. The Jaguarundi is a wild cat, right? And the Jaguarundi is present all across the Americas, from Canada to Argentina. It has sometimes different names. It's a sort of puma. It's a subspecies of the puma. And here you see the distribution of the Jaguarundi across Mexico. It has a strong presence in the north, particularly in the Pacific coast, but you find also some clusters of this wildcat in the south, in Chiapas, and also in the Yucatan Peninsula, where maybe some of you have been in holidays. Now, the Jaguarundi is an apex predator. So in the ecosystem where it lives, the Jaguarundi is always the main predator. It requires, therefore, a very complex structure that supports his existence. He needs to have a prey, for example, and those preys need to have food in order to exist, right? So there is a very complex structure that allows this wildcat to exist. This is, by the way, the size of the table here, some 80 centimeters long. So we thought that maybe, and Serafin has an important role to play in this idea, that maybe the presence of wildcats across Mexico and the fact that their presence requires a very complex ecosystem that supports them can be used as a proxy to measure the quality of natural capital. And this is a very interesting idea, we thought. Okay, so the idea, also basically what we did was to hire 3 research assistants. We gave them a backpack and a sandwich, and we sent them for 2 years across Mexico to count each individual. No, we didn't do it. So we use historical data, incredible data that the Mexican Commission for Biodiversity has been collecting since 1985 about the presence of top predators across Mexico. And this is only one example. There are 8 other animals. 7 of them are wild cats, and 1 is the coyote, which is not a cat. So we use this information to try to connect the idea that losses in natural capital may have consequences for the banking system. And we have a very specific channel in mind, and this is what I'm going to try to explain to you in the next 6 minutes. First, we are interested in connecting, I would say, 2 main ideas. The idea number 1 is that losses in natural capital can affect the economy by forcing the reallocation of resources, of productive resources. For example, you are a farmer, natural capital gets depleted, you need to leave the region because you cannot produce in that region anymore, right? That's a very concrete example. Second, we know that banks rely on deposits, and we know that they invest quite a lot on franchising for those deposits. So they need to invest in physical branches. We have been discussing this in the conference in order to sustain this deposit supply. Now, what happens if a region is affected by losses in natural capital and those depositors in those regions depart and leave the region? Well, potentially a bank that relies on that region as a source for deposits may face a funding shock. This is the idea that we want to test. How do we do it? So we will construct a measure of bank branches' indirect exposure to natural capital losses all across Mexico. We will connect these natural capital losses with the increase in branches deposits, or with the change in branches deposits over a long time period. And we will try to see whether this has an effect or not in the reallocation of bank deposits, particularly when natural capital losses are paired with with an intensity in agriculture. When a region is highly dependent on agriculture, we speculate, this is a conjecture, losses in natural capital should be more important for the economy. Why? Because the ecosystem services will make that economy less productive. So this is the idea we want to test. Here you see a change, 2 maps describing the change in natural capital, 1985 to 2021. Don't need to explain this, you see just visually how the red areas have been expanding over these decades, which implies basically that we have ecosystems with a much poorer quality all across the country. Now, I will just skip this because I just explained it. The way we operationalize the question is by asking whether natural capital losses can induce a reallocation of bank deposit supply. And we will be comparing, as I was saying before, the deposit growth of branches that differ. So they are operating in a given region, but they differ in their ex-ante exposure to natural capital losses elsewhere through their banking conglomerates. How do we think about this? So think about the following diagram. You have 2 regions, brown and green. The brown region is the one that has a large negative effect of losses in natural capital, whereas the green region has a large endowment of natural capital, 2 regions. And you have 2 banks, Bank A, Bank B. These 2 banks operate in those regions, and therefore they raise deposits in those regions. Now, what we speculate is that, for example, in the brown region, once that region becomes negatively affected by a loss in natural capital, firms and people may migrate out of that region just because it becomes less productive, there are less jobs, you cannot produce in the agricultural sector anymore. They will move maybe to a destination region, a 3rd region, the blue one here. If this is true, and if the Bank A is at the same time highly dependent on deposits that were raised, that were obtained and sourced in the brown region, then this Bank A will have a problem. Because this bank will suddenly see that those deposits that it was using for their production of credit and other financial services is not available anymore, right? And this is precisely the hypothesis that we want to test. One important aspect to mention is that we can basically address the main concern that you will have in any design like this, which is the endogeneity of losses in natural capital and banking activity. So obviously, both things are interrelated, right? So you can have losses in natural capital because of the banks. At the same time, the banks can face the consequences of natural capital losses. So what we do is to consider an exposure measure. This is one of the two only equations I will show, which considers the loss in natural capital in all other regions different than yours. So you are physically in a municipality and you have 2,000 other municipalities, so you compute the loss in natural capital in those municipalities, weighted by the share of agriculture in those regions, in those affected regions. The idea is that if your bank is active in regions that A, face a large loss in natural capital, and B, are highly dependent on agriculture, and C, are important for the provision of deposits for that bank, then you become exposed. This is the idea. So the exposure comes from outside the region where these branches operate. And then we will run a very simple regression estimating the change in deposits over a long time period between 2014 and 2021 as a factor of this exposure. Okay? So super simple idea. There are some fixed effects and fancy things that I don't need to explain. The data we use is basically composed of three elements. Bank branches in Mexico. Mexico has some 2,000 and something municipalities, so it's a large data set. We have the natural capital index constructed, as I was mentioning before, and we have the share of agriculture per municipality. This is the main idea behind the natural capital index we're using. This is basically a combination of two factors, the ecosystem quality and the ecosystem quantity. The quality is basically a measure of the quality of the ecosystem in a region, measured by the quality of predator-prey relationships. This is a complex index. I don't have the time to explain it now, but just think that this is based on capturing 9 dimensions of the quality of the interactions between, for example, a puma and the prey of the puma. Okay? And this includes things like, for example, the spatial connectivity of those ecosystems, the predator richness, the remnant habitat, and the functional diversity of those regions, just to mention some of them. This is then aggregated into a single index per municipality, and here you see the results of this analysis. On the left-hand side, the index as of 2021. On the right-hand side, in red, you see the regions where natural capital was lost to the largest extent across Mexico. These are the branches that we will be using in the analysis, and let me briefly summarize the results. This is a maybe ugly table just with some coefficients, but let me try to explain to you what they mean. Basically, the columns 1 to 6 to 5 just test different specifications, different versions of the same specification that reach the same conclusion, more or less. Namely, that a large exposure to natural capital losses, weighted by the importance of agriculture, leads branches to increase their supply of deposits in non-affected regions, in the other regions. That means they are basically trying to replace, this is a conjecture, right? Replacing those lost deposits by new deposit rates raising new regions. Econometrically speaking, a 1 standard deviation higher exposure is associated with 32 percentage points larger increases in the deposits over this long time span. So this is a sizable effect. It reflects around 30% of a standard deviation of the dependent variable, so the change in deposits. So we are explaining a sizable share of the variation in the sample. Now, there are 2 final messages I wanted to deliver before concluding. One is to ask, where are banks reallocating their deposit production? And second, whether the fact that they are active in agriculture in particular plays a role. We conjecture 2 things. Banks may potentially search regions that have a high natural capital endowment. And B, banks may maybe search and prefer to reallocate to regions that have also a large agricultural productivity. We test this in this table here. So in columns 2 and 3, you see the same specifications that we're testing in our baseline, but we distinguish between regions that have a high natural capital endowment versus a low natural capital endowment, columns 2 and 3. And we find that the results can only be replicated if we look at regions with high natural capital endowment. These are the destination regions of the diagram I showed you before. So this means that banks, when they are facing a loss in natural capital that affects their capacity to raise deposits, they reallocate preferably to regions with high natural capital endowment and regions with high productivity in agriculture. I will skip this part and just finalize by saying that we also tested a few extensions. For example, we know that this is also affecting credit, particularly consumer credit in the destination regions. and that eventually, after the banks reallocate this production to the destination regions, those regions, in a second iteration, face losses in natural capital too. So this is what we call a natural capital depletion spiral, in which the reallocation of banking activities is at the end eventually further spreading the loss in natural capital across the country. And very important, maybe more interesting for econometrics, but I think it's an important message. You can destroy these results very easily if you do one thing. And it's super easy. You need to exclude agriculture from the equation. If you take agriculture out of the equation, nothing holds. There is no story to tell you. All this presentation will be meaningless. So this is important to mention. Why? Because the reason why we care about natural capital, at least in this context, is because it affects the productivity of agriculture. And this is the driver of this funding shock we identified that affects the capacity of banks to raise deposits. With this, I can conclude. So I just wanted to say that the main policy implication we have is that if this is true, if this story holds, it means that there is a big problem, because we would actually like funding to be channeled to these affected regions so that they can adapt, right? But what we are seeing is that when the bank sees that the region is affected, they depart from the region. Could be this for this reason, right? Because they lose access to deposits. Could be another reason. But the fact is that they depart from this region. This is very critical for the financing of any green transition, or in this case, a transition towards activities that are not destroying the environment. And this is maybe the main red flag that we are raising with this study and the main policy implication that we have. Thank you for your attention.
Thank you, Mr. Ossandon Busch. Ms. Paola, I pass the word to you.
Okay. So first of all, thank you to the organizers for this invitation and for the wonderful organization, really. Yeah, I'm going to switch a bit the focus of your attention to another topic, which is not, oh, yes, sorry, which is climate risks instead of nature-related risks. And in particular, I will try to answer to the research question of, which is the title of this session. And yeah, let's see together how do we, what we learn at the end of my presentation. So this presentation is about an idea that I got some months ago to try to analyze and find out whether there is a paradigm shift in central banking. And in particular, if we can talk about green central banking and how this is evolving in the, let's say, globally. So I start from just looking a bit about the landscape of central banking in the last century. And yeah, we know that at the beginning of the century, there was a transition from the gold standard to fiat money systems. Then in the 50s, the concept of central bank independence became more popular. The focus was more on long-term price stability and also the idea that monetary policies should be insulated from governments, so from policy decisions and political pressures. And then in the 90s, we had this focus on inflation targeting, so the adoption of specific inflation ranges to stabilize prices. And after the global financial crisis of 2008, we see a greater emphasis on financial stability with the adoption of macroprudential policies and also some attention in some countries to unconventional monetary tools like quantitative easing. But what we observe in more recent years? Well, in more recent years, we observe a gradual increasing attention to climate-related risk topics. Let's frame it like this for the moment. And why can we say this? Well, we can say this. In the last years, I've been collecting a lot of data regarding the adoption of what I call climate-related financial policies. Under this definition fall several types of policies. So we have green prudential policies, green credit allocation policies, disclosure requirements for non-financial institutions, of course with a green or climate component, green bonds issuing or taxonomy, adoption, and what we can more generally define as green financial guidelines. And as we look at this plot that I could create by using this data on the policies adoption in the last 20 years, we can see that for all type of policies, I will explain in detail in a while what are these policies in detail, but we can see this trend in the increasing adoption of each one of these type of policies that compose this climate-related financial policy, let's say, box or definition, okay? And we can also try to understand their evolution by looking at the main international, let's say, policy events. For example, the adoption of the Equator Principles. We have the Principles for Sustainable Insurance in 2012, for example. Then we have the creation of the NGFS in 2017. So this is to try to set the stage, okay, and see that there is this increasing adoption of this kind of policies. Then another way of looking at this picture is to consider also another part of my previous research, which is the development of this climate-related financial policy index, which is a statistical index or composite index that I created and I published 2 years ago to try to assess, quantify, and compare the international engagement in climate-related financial policy making. And the idea behind the index is that the higher the index, the higher is the country involvement in climate-related financial policy making. So the map that I show here on the left shows the adoption or this climate-related financial policy index in 2020. And here we can see that the champions, in a sense, the green champions for the climate-related adoption, so I'm not talking about the efficiency, the efficacy, or whatever, just the adoption of the policies, are Brazil, France, also the Netherlands, which is tiny and does not show up very clearly. We have China, Australia, Indonesia, and South Korea. We can also dig a bit deeper into the information that we have in the index. And I also wanted to show some additional graphs, so these stacked bar charts on the right. And we can distinguish what happens between or among advanced economies, what are the differences between advanced economies, emerging economies, and developing economies. And just to give you an idea, we see that, for example, in emerging economies, there is a higher adoption of, so these blue bars are the green prudential regulations, while, for example, in advanced economies, we have a majority of green color, okay, in the chart. So these are the disclosure requirements for non-financial institutions. So we see a lot of heterogeneity, but we see a lot of engagement, okay, also across the years. So the map shows only the picture for 2020, but if you look at the charts on the right, you can see what happens year by year, the shares of adoption for the different policy types. So with this background in mind, I started to ask myself, so considering that there is this gradual or increasing attention to these topics, so increasing attention to climate-related financial risks, and that there are countries that have been adopting this kind of policies, with different type of policies. We are not talking just about financial stability-related policies. It's a broader range of policies. So can we talk about a paradigmatic shift in central banking? So this is what I'm going to present you now, today, and the idea behind this, or the objective of this research is to investigate, first of all, the transformation in the global financial system, and also to examine the empirical evidence of a paradigm shift. And in this way, I would like to contribute to existing literature in order to stress the possible significance of these changes in paradigms in central banking, but also to study the evolution of financial and monetary policy against climate and environmental challenges. So how do we do this? So I structure this research in 3 steps. So first of all, I start with the analysis of the policies. So originally, in this research that I showed you with the map and the charts, I collected about 400 policies for 84 countries, something like that. And in these policies, we have the, in this data set, we have the policies for all kind of actors. So we have central banks, financial supervisors, but also ministries of finance or banking associations. So different types of institutions, let's say, that pushed or implemented this kind of policies. But in this analysis here, I selected only the policies which were implemented or adopted or, let's say, pushed by central banks, financial supervisors, and regulators. So I reduced the data set because I wanted to focus only on central banking. And I ended up with a data set of 184 policies, and also let's say the geographical coverage reduces a bit, because from 84 countries we end up with 52 countries. But still, I think this is still valuable and interesting. And the time span goes from 2000 to 2022 because we extended the original data set. Then in a second step, we apply Peter Hall's theory of change. So this theory is very popular among political scientists, but I think it's very useful also for this analysis because it helps to categorize these identified policies, financial policies in our case, according to what Peter Hall calls orders of change. I will define it in a while. And then using this, theory, okay, that we apply to our framework, we investigate whether we can, so we apply our analysis in a sense, and we investigate whether we can talk about this, whether there is a paradigm shift in central banking, and also we try to distinguish what is the situation in advanced economies compared to EMDs. Okay, so the first step is the analysis of the climate-related financial policies. So again, this builds on previous work where I created this taxonomy of 5 policy areas. I call them like this in my research. 5 policy areas where we have, so the first one is the green prudential regulation or regulations, which are those policies aimed at promoting the development of green macroprudential frameworks. And here I use the standard Basel, let's say, framework that distinguishes between capital, liquidity, and large exposures. And just to give you an idea, on the last column, I provide some examples for the policies that are in the data set, okay? And where you see that there is no example, it means that no policy has been found for that specific type of, so no green policy, okay, has been found for that specific category. Then we have the second policy area, so we have green credit allocation policies, so the policies to directly promote green credit measures and investments. Then we have the green financial principles, so just principles that allow a better development of green financial markets. Disclosure requirements, so those requirements to promote the public disclosure of climate risks. And finally, green bonds, taxonomy, and issuing. So this is the framework, the policies that I use. And then the second step is to apply Peter Hall's theory to this, to my data set, okay? The data set that is structured by using these policy areas, okay? And as I said, selected only for those policies implemented or adopted by central banks, financial supervisors, and regulators. So I take this Peter Hall's theory of policy changes that says that we can differentiate between minor adjustments and major paradigmatic changes, okay, by looking at the content of the policies. So this is really a structured framework that allows us to study the policy evolution. So the first order change is, or we can observe a first order change when there are only adjustments in the setting of policy instruments. So this involves just the fine-tuning of existing tools without altering the policy overall goals and methods. Then we have a second order change, which implies another step, okay, in the changes, which is a bit more consistent, a bit more, let's say, important towards the evolution of the policy, and implies changes in the techniques or policy instruments which are used, but still the overarching goals remain the same. And finally, we have third order change, which instead is, so this is what we can call the real paradigm shift kind of change, because it affects the overarching goals, the values, and the techniques of the policies. Yeah, so basically I used this, I translated the theory of policy changes from whole into the context of central banking. And yeah, I believe that this gives us a more structured framework to understand these policy changes, and also it allows for a very valuable cross-country comparative analysis. So by applying this theory, we end up with an additional, let's say, data point in our data set, which is the label for which kind of order of change does the policy belong to. Okay, so we have a data set where we have the countries, the years of the adoption, the kind of, the type of authority which is responsible for it, the content of this policy, of course the policy type, and then we also attach a label to which kind of order does it belong to, because we need to perform some kind of empirical analysis, or we would like to perform some kind of empirical analysis, so we need to attach a label to each one of these policies. And this is how I do it. So, for example, for climate-related disclosure requirements, I say that when I read the content of the policy and I see that there are only minor adjustments to existing rules, of course, with a climate tweak in a sense, I say this is just a first order of change. Then if by reading the policy content, I see that the country introduces new forms of reporting, then this could be labeled as a second order of change. And finally, when the authority redefines the corporate responsibility and financial transparency, this can be considered a third order of change. And then I do this basically for every policy area, so disclosure requirements, stress testing, which is the proxy for prudential regulations, because we do not have other kinds of prudential regulations in this framework, okay? Then green bonds, green credit allocations, and green financial guidelines. So I do this for every kind of policy, so 184 data points, and then we can do some empirical analysis. So first of all, we look at the temporal evolution of the orders of change. So on the horizontal axis, you can see the years, okay? So we start from 2000 and we end up in 2022. And on the vertical axis, you see the orders of changes. So the first order of change, as you can see, it's quite, so it has a lot of observations, okay? Of course, the majority of these policy adoptions starts from 2012, basically, and it continues until 2022. The third order of change has less observations, but the core of the adoption is basically towards the end of the temporal scale. But the second order of change is the one that has the most observations, okay? And also it's concentrated towards the end of the period. In terms of the global diffusion, here I don't show the second order of change, but only the first order, which is at the top, and the third order, which is at the bottom. And this is to show the engagement at the global level. So we can see very clearly just by looking at the graph that The first order of change is more heterogeneous because we have countries from different, let's say, income levels and different continents. But the third order of change is more concentrated in a sense that I would say is led by the global south. Okay, we have some outliers, so Hungary is one outlier, positively, I would say, and Finland as well. But the change, basically, the paradigm shift in this case, I would say, is led by the global south. Also, another way of looking at our results is to aggregate the data by decades. Okay, so we have a first set of results for 2002, then a second set of aggregate data for 2012, and then 2022. And we distinguish also between advanced economies and emerging markets and developing economies. So we see that the second order of change is led by advanced economies. So this bigger green dot, okay, advanced economies are there, which is also true for the first order of change. If we look at the numbers, so the green dot is actually bigger also for the first order of change, but everything changes in the third order of change. So there is actually no role for advanced economies. We just have this big blue dot in 2022, and this is the cumulated values between 2012 and 2022. So I just want to stress this, okay? So this is important, okay, because this shows the global distribution, okay, also of the commitment to this kind of policymaking. And yeah, I go quickly to the main findings. So the main contribution of this analysis was to show how financial policies are evolving in response to increasing climate risks, and also to illustrate the financial system capacity to adapt to the challenges on the global scale. And we see that both the temporal and content dimensions are observable through this analysis. We claim that this evolution, okay, both on the temporal dimension and on the content dimension, is consistent with whole theory of policy changes. And finally, we observe, because it's clear that there is this shift, okay, this paradigm shift from the second to the third order, but we have to stress also by considering the ongoing discussion that green central banking is still a contested and evolving concept. We know what are the main what I call opposing factors or hindrances, which are mainly related to political considerations, institutional constraints, limitations in information and data that were discussed in the last days. So we can say that there is a paradigm shift in progress at the moment. I would say that it's not completed yet because a lot of things have to be done, and we need a major or a bigger involvement of countries all over the world, not just a small set of countries, which I would say in this case from the analysis is the global south. So we need a broader engagement in green financial policy making, but this is, I think, a nice picture to see how things have been evolving in the last 20 years. And here I stop. Thank you.
Thank you for your presentation. Mr. Borsos, I would pass the word to you.
Welcome, everybody. My name is András Borsos. I'm an economist here at the Central Bank of Hungary and a researcher in Vienna at the Complexity Science Hub there. And the project I'm going to present now is a joint effort of these two institutions. And this is about the amplification of climate policy risks by network contagion. Oh, thank you very much. So let's start by some motivation of this project. As you probably all know, there are several new policy plans out there to speed up somehow internationally the reduction of CO2 emissions. So I just mentioned a few now which motivated our work here. There is this second edition of emission trading system, the ETS2, which tries to improve our current emission trading system, where the main problem is that it only covers around like 25 or 30% of all the emissions happening. So in this second version of this ETS system, it will be a much broader scope, more industries would be covered, ramifying the situation. There will be also other changes. For example, no freely distributed allowances will be anymore, so there will be an auction system instead. And there will be also like a price cap, initially planned to be around like $45 per tons of emission. So the idea is that if the demand for allowances is higher and the higher price would be justified based on the market mechanism, then the supply side will adjust and they will issue new allowances, and those will be auctioned, and this adjustment will continue until we reach the price cap. So even though we have this $45 initial plan now, there are many opinions and arguments for actually much higher price caps, even 10 times higher price caps could be justified, according to some opinions, to reach our current objectives. So this is like one important direction of policy ideas which are going on now in the EU. Another idea is to put some extra carbon price on certain goods imported to the EU. And here the most important factor in the regulation would be to target the scope 3 emission, which means this indirect value chain or supply chain related emission of the production of products. So these are very like promising directions, and based on the previous presentations, we really need them, of course. So in this talk, I would just like to highlight that there is room for optimization regarding policies. So we should be able to assess the implications, consequences of these policies, especially if they are like introduced in a very strict and sudden manner, like following a command and control approach to speed up our green transition processes. So there can be like pretty obvious economic consequences for these cases. Like it obviously means a price shock, which can pose difficulties for companies to adjust in their like technology of production. It can lead to defaults of many companies and supply chain disruptions, which altogether means increased risks also for the financial stability of the countries. So these are like pretty obvious mechanisms, but we don't really have feasible tools to analyze them right now, because to really do this properly, we need a lot of data, which usually we don't have about the detailed steps of production processes. We also have only like quite partial knowledge, honestly, in economics regarding how the adjustments in production processes happen in the global economy. And even if we had all this information, it's still very challenging to model these situations. So in our project, we just propose a way, an idea how it is possible to take into account at least this supply chain-driven contagion mechanism in these models. And what we propose is a data-driven simulation methodology. So I'm going to spend like the first half of my presentation explaining why this direction is justified or even recommended, and the other half I will focus on the exact simulations and the results which we have based on this. So the most important piece of data was already mentioned by Stefan Turner yesterday, so I don't have to spend much time on it. Obviously, we need to observe the supplier connections in the economy to be able to granularly model the production processes. So this is rarely possible, but luckily in Hungary we have a VAT-based tax report data set, which includes all of this information. And for this particular project, we use the 2022 version of this data set, which covers basically all the companies, like more than 400,000 companies in Hungary, and more than 10 million trade links observed among these companies. Even though it sounds like very great, there are still shortcomings. So it's still just a domestic data set. We cannot observe the international trade links, and especially not the higher order links in international trade. We can only just see the aggregate export and import at the firm level, but not at the product level, and we don't know the further steps in the process. Also, observing prices or decomposing prices and quantities and identifying exact products is very challenging. It's not really possible, even with this data. So there is still room for improvement on the data side, but we could already start the process with this data which we obviously link to many more traditional data sets about the characteristics of firms, the financial system, banks, and loan contracts in the country. What we didn't know is also including financial system contagion channels in this project. That would be like a next step to do something similar to Seraphine's model. So it's complementary to that approach. And at the end, it would be very nice to merge these directions. But now I will not talk about that part really. Okay, but at this point, maybe you wonder that do networks in the real economy really matter that much? Do we need this granularity? Wouldn't it be enough to just use industry-level data? Why to bother with all this? So if you have these doubts, you are in good company, because in economics for several decades, this was the mainstream opinion. So there are very famous economists claiming these classical so-called irrelevance arguments regarding granularity and network effects. So some typical arguments were that actually these firm-level information, pieces of information do not really matter, because these idiosyncratic shocks or firm-level fluctuations just cancel each other out. So there is a diversification effect, because of which we can just ignore all of these things. There's another argument claiming that if we are interested in the importance of entities, either sectors or firms, we can just look at their sales share compared to GDP. It's called the Domer weight, and that will capture the importance. So network effects are not relevant. So we had to wait actually until the recent years or last decade to have results debunking these old arguments, highlighting the implicit and explicit assumptions which they were making, which empirically cannot be justified. So regarding the diversification argument, we saw that actually if we have heavy-tailed or power law, typically power law distribution of company sizes or characteristics of the production networks, then diversification will not work, because the law of large numbers breaks down, and it would just take infinitely long to wait for diversification. Also, the Domer weights can change a lot after a shock, so there are second-order effects which are explained by network mechanisms, and all kinds of frictions get introduced in the production networks because of this, if we go to this granular level, which are relevant. So now the consensus is, even at theoretical level, that we need to take into account all these granular interactions. But I can also show you an empirical result from our own research. We have a paper on explaining the information loss which we face if we ignore the granularity of the economy. So here what we did is examine the assumption that all the firms are assumed to be homogeneous if we work at the industry level, because then we don't differentiate between them, of course. So, but with our data, we could take a look at the input and output structure of the firms and see whether they are really similar regarding those firms which belong to the same industries. So we just created this simple measure. We call it relative overlap coefficient, which can show us actually the fraction of the, for example, inputs firm I and firm J buy from the same industries. Or similarly, it can be interpreted for output similarity as well. So this is a measure between 0 and 1, showing similarity of this production structure of companies. And what we found, you can see on these plots, on the top it's input overlap coefficient, and the bottom is the output version of it for each NACE2 categories. So these are very narrow box plots basically for all the firm pairs belonging to these industries, and we can see a distribution of their similarity. And what we found is that the similarity is actually shockingly low. So usually it's around 30% for most industries. So when we assume in an industrial analysis that firms behave the same way, then we can have big uncertainty around that result which we generate this way. And also it matters a lot which firms are actually affected by a shock. If we are talking about climate-related shocks, if we assume an industry-level shock, we would assume that all the firms are homogeneously affected, while we see in this case that if we have this large heterogeneity, it really matters which are the firms exactly affected, because if they have different input-output structures, they will transmit the shock to different directions, different dimensions regarding the production space. So, okay, these are just some justifications for our approach. But let's turn to the simulation methodology which we are doing. I put here the same toy model Stefan used yesterday, just to make it easier. So if we observe connections between firms, also between banks, but now we ignore them, we can have this simple story that, okay, let's assume a single firm gets shocked here, firm F, which leads to all kinds of problems in the supplier network. For example, one of the buyers, firm D, cannot replace this supplier in the short term, so it might also default or becomes non-performing on some of the loans it has. So this way, on the banking layer, bank 3 and 4 get affected, but not only due to the direct shock, but it will also be amplified by this contagion effect in the production network, and even banks which are not even connected initially to the shocked firms can suffer losses. So if we want to take into account all these contagions at the firm level, then we need like a model to do this, and we opted for a simulation model because analytically it's very difficult to handle these systems. So in our simulation, we did the following exercise. First, we constructed firm-level initial price shock coming from these command and control type policy interventions. So we could create this firm-level price shock using some empirical emission data and also the observations we have in the supply network. So we could identify the exact exposure each firm has towards the targeted industries by the regulation. So this way we can have this initial shock vector at the firm level. So this is basically a price or cost shock to these firms, which reduces their income, profit, leading initially to the higher probability of defaulting on their loans. There can be like two consequences in these situations. The first one is that firms affected also indirectly, they halt their production and also they default on their loans very often. So both of these consequences are taken into account in the simulation. And so actually the most important part probably is how we model the behavior of firms in these production processes. And this again was mentioned briefly by Stefan, but I want to mention a few more details which might be interesting and important here. So actually we can individually calibrate the production function of all the firms regarding the short-term production processes. So here we mostly ignore the labor and capital substitutability because those are just much longer, those processes have much longer time requirements. So we focus on intermediate inputs mostly. And we create this generalized Leontief production function based on the idea that all the firms have essential inputs and non-essential inputs, and the disruption of the supply chains regarding these different types of inputs will trigger different reactions for the firms. So if we take the example of a table manufacturer, which needs wood and screws to put together assemble tables, and the wood is not available anymore, obviously there is no possibility to create a table in the short term. It takes time to switch to metal table technology or something. But it can also happen that this same firm has a marketing agency partner, and if that marketing agency defaults, it will not really affect that severely the production of the firm at all. So we need to combine different types of inputs here, and that we do with this generalized Leontief functional form. Oh, sorry. Okay. Yeah, I won't go into the details of the technicalities here. It's just important to highlight that what we do is an iterative process here. We always assess the constraints and opportunities of firms in the system regarding how easy they can replace certain suppliers, what is the fraction of essential and non-essential inputs they have at the given moment of the process, and what are the constraints they are facing regarding upstream and downstream constraints, like how easily they can sell their products and what kind of difficulties they have by acquiring their inputs. So we update these equations iteratively until it converges. It's proof that it converges to a stable situation again. And that's the basic logic of our model. Okay, so I will turn to results now. Maybe the most important thing which we noticed in this particular policy shock scenario, which we considered, is that there is a huge nonlinearity in the results depending on the price shock which we introduce. So as I mentioned, now the current plan is to have this $45 price cap, or maybe it's euro, sorry. But so there are certainly discussions about much higher values for this, so we try to explore this space a bit. And what we found is that on this plot, you can see these different scenarios for different price shocks and the losses of the banking system after taking into account these contagion channels, the direct and indirect losses. So what we see is that, yeah, the $45 level seems like totally safe if you consider only this contagion channel. It's not a complete model, it's just a partial picture of the situation, but it looks totally safe. However, after a transition point, some crossover happens, and it leads to huge losses immediately in the output or the production capabilities of the economy. So why is that happening? It's because of the interesting topological features of these production networks. We have so-called plateau firms if we examine the systemic importance of the firms in the economy. So here, if you focus on the bottom plot and this solid blue line, that's like the rank-ordered representation of the systemic importance of all the firms in Hungary. And there is this plateau representing the most important firms. And these firms, not many firms, but there are like 30 firms there, they form a strongly connected component of highly critical supply relations. So this means a core of the production system which are very vulnerable and strongly connected. So if something happens there, that triggers a big and very powerful contagion effect there. So when these firms are hit, then we see this big phase transition or this crossover in the process. So even though the $45 level seems like very safe now, we have to notice that this crossover point is highly dependent, very sensitive to the topology. So we are now using only the Hungarian network with quite a few limitations. That it can happen that in another countries' network we would see with different results. Also, the modeling assumptions matter a lot here. So the important message is here just when we create policies, it's very important to make it sure that we are on the safe side of this sigmoid function. It's worth examining this. And now we are not entirely sure where this transition happens, but this nonlinearity is very a robust result in all the specifications. Okay, an additional result I want to show is just the disaggregation of the similar result we have here. So we can go to, because of the granular nature of the analysis, we can go to more disaggregated results, like focusing on the losses of the banking system coming from firms belonging to different industries, for example. And here you can see two scenarios, the $45 shock and the 10 times higher shock scenario. And what is obviously visible immediately that there's a high level of similarity between the two, and it's quite intuitive which industries are the really important ones. That's not really surprising. But what we can also see that the role of direct and indirect effects can be very different across the different scenarios. So if we want to focus our attention to certain industries, it's really influential how to do that, because direct and indirect vulnerabilities are totally different. So this distinguishing between these type of losses which are caused there is important. Also, I can mention the fact that the losses happening in the financial system are not really proportional to the production losses, the production drops in these industries. It depends on the distribution of loans and financial buffers across firms belonging to these different industries, how the production losses are translated into financial losses. So that step is not trivial at all. Okay, and lastly, I just want to show another result. So here's another variant of our analysis where we also considered liquidity type default events for the firms. That's a bit more tricky because we have to make more stronger assumptions regarding the default criteria. So the losses are higher here, but that's not really the important point. The more important thing is that we looked at the liquidity gaps, the missing liquidity of firms in this analysis, like how much liquidity they would need to survive in the different shock scenario. And what we found here, you can see two groups of firms, bank clients and non-bank clients firms. Obviously, only bank clients firms cause the losses to the banking system. So if you just consider how much liquidity need they have, it's much lower than the losses they cause. So some targeted and optimized program to allocate some liquidity to the vulnerable firms, which pose threats to from the point of view of the contagion process, can be quite like efficient way to mitigate the effects, even in the case of these like seemingly dangerous cascade events. So maybe the cost which we actually are facing here is lower than these losses, these numbers and losses would indicate, but it would require like a new type of interventions which are not obvious how to make. Okay, I'm out of time, so I will, I guess, keep these things. I just maybe reiterate that the next step would be for us to connect our framework with the banking system contagion model, and we are already working on that. We have actually a model for that. We just need to put the two parts together to see what happens if we do that. And as Ben Samero, my colleague, mentioned, we are also working on a macroeconomic ABM, which we plan to be also well suited to host these kind of modeling blocks to be able to analyze also feedbacks from other macroeconomic mechanisms. Okay, so I'll stop here. Thank you for your attention.
Thank you very much. Thank you very much, András, for your presentation. Now we'd like to open the discussion once again for questions from the audience.
Very good work, András. It's always impressive to see what you have been doing recently. Now, in order to guide the carbon prices, have you think also on using integrated assessment models to link to some policy scenarios? I think that's one of the missing bits also that you have. And also the technical coefficients for the substitutability of some of the goods coming from nature. I think this is one very interesting approach that can be, your approach that can be used for that as well, because one of the things with nature is that it's very hard to substitute with labor and another type of forms of capital. So I think this approach will allow you to do that. So, and the last bit is, also with this framework, have you considered to see some of the monetary policy implications? Because it's not only about financial stability, but also about how different carbon prices might affect the monetary policy, inflation, other things there. Thank you, and congratulations.
Thank you. So regarding the first question, yeah, we like assess the integrated assessment models, and yeah, you are right that it would be also a nice next step to try to harmonize this type of modeling with those. We haven't started working on that direction yet because our hands are full, but that's a very good point that would be also a good step forward. Regarding substitutability and its resources you mentioned, I think the main constraint for us is the lack of data for that. Hungary is a very open economy, and even if we can observe the direct international trade links, that's still not enough to like properly capture these type of risks. So there are some like international cooperations, like large projects, which aim to reconstruct globally the supply chains to some extent, at least regarding the most important resources. And I think if those projects can be successful, that would be like a huge step to this direction to be able to take care of these effects as well. On monetary policy, that's exactly one of the objectives of our work regarding the macroeconomic ABM project. There, it would be like feasible to take those into account, but that's probably have to wait a few years for that. Thanks.
We have another question there.
Thank you. Thank you. Brilliant presentations. Matias, I've got a question to you. You're showing that banks withdraw from climate-affected regions. Let us forget about causality, right? But definitely they withdraw. Whatever triggered it, they withdraw. Agricultural projects are typically very high risk. They are not diversified. They are also led very often by people who don't have high financial literacy, etc., etc., etc. Yet they are so important. How to mobilize bank to open capital, to invest in those areas, to invest in agriculture, to invest in biodiversity, to invest in production of food. Do you have any suggestions how to stimulate the banking sector?
We have been discussing this because it's obviously the key policy kind of discussion that you can draw from the conclusions of the analysis. And so far, I will say, discussing this with the co-authors, we think that, I mean, this is what we claim, at least in the paper, is that the reason why the bank decides to reallocate its production is not simply because it decides to leave people to die in the wasteland, but it's because people already left the wasteland. People and firms, technically speaking. So those that are the source of these deposits that the bank relies on are not there anymore because the region became unproductive and unfeasible for agriculture in this particular case. If this is the case, our conclusion is that there is much more a role for, let's call it, social fiscal policies than for bank regulatory policies. And the reason is that you first need to prevent people to leave that region, and for that you need to somehow provide them with all the sources of support in order to compound, if possible. I mean, as Serafin was pointing out, this is very difficult to do in practice, but to try to reconstruct the natural capital that was lost in this region. Because otherwise, I mean, for the bank, it's not that the bank is leaving because they're necessarily bad people or because they don't care about the environment. Maybe that's a reason too, but in our setting, being super specific with what we find, the reason why they leave is because people and firms already left.
But haven't they left because there was not enough capital to invest?
Sure, yeah. Obviously, you have an endogeneity there, yeah.
So the banks haven't invested in the first place. They didn't build up relation banks or whatever was needed, or innovating banks, as they call them, haven't invested. They are far too risky projects for them to bother because they're also not very profitable.
Yeah. No, I fully agree. I don't have a solution, to be honest. I think this maps into the broad discussion of financing the green transition in general, and we know how difficult this is in terms of the frictions that are involved. And at least from the Latin American experience, the few relatively successful stories I have heard in this area have mostly to do with trying to support the borrowers more than the banks. So in the sense of, for example, providing government-supported guarantees that can ease the access of this excluded borrowers to the formal banking system in order to support a transition. Is what I have heard, like in terms of examples of success stories. Not so much of intervening the banks themselves, but certainly there are things you can do, and part of it maybe it has to deal with how we can incentivize banks to increase their exposure to projects that indeed are attempting to finance the green transition. Yeah.
Thank you. We will move on to our last question. Thank you.
Thank you. I have a question for Paola. I was wondering a little bit about your statistics that emerging markets, especially China, were dominating your examples about green finance, actions, proposals, whatever. Is it just better communication, or are they doing a better job from your point of view compared to EU, ECB, whatever?
Well, the data, I think, speaks for itself. So what I observe is just really that China has the highest score for wherever year you look at. So it has the highest engagement in this kind of policies. In another study, which kinds of confirms these conclusions, but I called Chinese engagement authoritarian environmentalism, which is also let's say a label that I found in other papers. So in a sense that the government is really engaged in, maybe we can call it greenwashing if we want to be critical, but I cannot say, because I think more research is needed to understand, for example, if this kind of policies at the end are leading to, for example, really containing financial instabilities or promoting green finance. We do not know about that, and actually this is the topic of another paper that I have, but yeah, this is there is a lot of work in progress, but yeah, the data says basically that China is the country that is the most engaged in this kind of policy making, and then it's followed by Brazil. So, yeah, so this is the story.
Thank you for the questions and thank you for the engaging discussions. With the closing of this session, we have reached the end of the MMB, CEMLA and ONFIF Financial Stability Conference 2024. Before officially closing the event, I would like to ask Mr. Ádám Banai, Executive Director responsible for monetary policy, financial stability and foreign reserve management at the Magyar Nemzeti Bank, to tell us his closing remarks.
So, first, let me express my gratitude to all those who participated in organizing this event. So, let me thank to the CEMLA, to ONFIF. You made a great work, and thank you for joining us. It was really an honor to work with you. Let me thank all the speakers. I think we learned a lot. Personally, I learned a lot. So, I think it was a great event. And let me thank my colleagues, Katinka and Jani especially, who did a great job in the last months. So it took a lot of work to get here and to show these 2 days. So I think it was a very nice event, and we can be very proud of it, that we have so many people from around the globe, from the top of their fields, and show us where we are now. It is just very hard to conclude after 2 days. I have a lot of notes about it, because we went through from macroprudential policy to supervisory issues, to resolution, from AI to climate change. We have heard even about bees, which were very important. Actually, if you don't know, in the US, you have to pay for the landowner if you want to put there the bees to make honey. But in Hungary, you have to ask for permission from the landowner to put your bees there. So there's huge differences in this field as well in the countries. One of the main sentences what I've heard yesterday was that you should trust that who have at least a plan, which was said by the resolution board chair. And I think it's very important that you should trust who has at least a plan. And I think we have more than a plan, because we have built up so many strong systems like the macroprudential policy framework, and I think this system proved to be safe during this during this economic environment with the war and with the COVID. So I think we can be very proud of this safe system. And I think it is important that we see that we could fight against inflation in the last years without a big turbulence, although some minor banks in some other countries out of Europe had some problems. So I think it is a great result. And the reason behind it is that we started to be more prepared to work on prevention, and like in the macroprudential policy. And I think we built up good backstops as well, like central bank swap lines or repo lines, which were very important in the last years, like much wider set of deposit insurance, and all the resolution framework is a good backstop facility. So I think we made a lot of effort and we made a lot of success in the last decade. So the question is, what is the future? And for sure we have more questions than answers that, but I think what we have seen is that we have to strengthen further the system. For example, it was nice to hear that Brazil and Mexico has a swap line with the Fed, but for us it is still a pity that we don't have a similar tool with the ECB. So I think stabilizing the system is in all of our interest, and we have to take steps towards each other's. And in the longer future, I think is a big question what the central bank's role in climate change. So we show one type of role as a Central Bank of Hungary. So we try to facilitate the financial system to be more sustainable and green. So this is one direction. I believe that it is the good one, but we have seen on the chart that Hungary, in this sense, is closer to the global south, and probably later the north will continue us. And digitalization is also a big issue. AI is coming, and as we understood, it will be faster, it will be more customer friendly. But what else? We see the risks. We see, for example, the herding effects, which can have something similar like the algo tradings for countries like Hungary or smaller ones. We see that probably it will have a negative effect on depositors, so that at the end of the day on the stability of a banking sector. So what we should do, covering every deposit, or what is the direction after all? I think these are big questions, and I could continue with many questions, but my time is over. So thank you very much. It was a great event, and personally I'm very proud to be able to welcome you here, and thank you for all you.